You know, when you first get into investing, it's so easy to think it's all about picking that one perfect stock at the perfect time. But what if I told you that the single most powerful factor in your success has absolutely nothing to do with timing the market or even getting lucky?
So what is it then? What's the secret sauce? Is it finding the next huge tech company? Or having some kind of super complex algorithm? Maybe it's just plain old luck. Well, you might be surprised to hear that the real answer is actually way simpler and a whole lot more reliable.
That's it. It's time. The amount of time you have on your side is the biggest driver of your entire strategy and your potential returns. So in this explainer, we're going to break down exactly why your personal timeline changes, well, pretty much everything.
All right, so the very first thing we need to wrap our heads around is this core concept. I mean, before you even think about buying a single stock or a fund, you have got to define your investment time horizon.
And it's really as simple as it sounds. Think of it like a runway for your investments. Are you saving for something just around the corner? Or for a goal that's way out there, decades from now? Because that one question, it is going to shape every single decision you make from here on out.
Generally, we can break these runways down into three main buckets. You've got your short-term goals, anything less than 3 years away. Then there's the medium term, for stuff that's maybe 3 to 10 years out. And finally, the long term, for anything 10 years or more in the future. And trust me, each of these requires a totally different flight plan.
Okay, so how does this actually play out in the real world? Knowing your time horizon isn't just some abstract mental exercise. It literally tells you what kinds of assets you should be looking at for your portfolio.
Here's the key. If your goal is short-term, your number one job is to protect what you have, to preserve your capital. You just can't risk a big dip right before you need that money. So you lean into safer things like cash, bonds, or GICs. For a medium-term goal, you're looking for more of a balance, right? A mix of stocks and bonds can give you that blend of safety and growth. But for the long term, that's when you can really hit the gas and focus on maximizing growth. And that usually means a portfolio that's heavy on stocks.
And this is where things get really powerful. Because a long time horizon doesn't just open the door for more growth, it's also your absolute best defense against the wild swings of the market. It's your secret weapon for staying calm when the news starts to sound scary.
I mean, let's be real for a second. Watching your account balance drop is stressful. Nobody likes it. And in any given year, the market can be a total roller coaster. It's just a fundamental truth of investing. Returns are never guaranteed, and yep, you can lose money.
And to really drive this home, just look at this number. Back in the 2008 financial crisis, the S&P 500, which is just a big basket of 500 large U.S. companies, was down a whopping 43% in a single year. Now imagine if you needed to pull your money out right then. It would have been an absolute disaster.
But, and this is so important, if you didn't need that money for another 10, 20, or even 30 years, that huge drop is suddenly just a bump in the road. Time gives you the superpower of being able to just wait it out for the market to recover, without being forced to sell at the worst possible moment. This chart just illustrates the point perfectly. Look at the bars on the left. Those are one-year returns. See how they're all over the place? Big gains, sure, but also some really painful losses. Now, look over at the right. Those are 10-year rolling returns. See how much smoother that looks? All those nasty drops just get ironed out by the good years. It's amazing. Time literally tames risk.
All right, let's pull all this together and see how it works with real-life goals. Because at the end of the day, knowing your time horizon is all about connecting your money to the life you actually want to live.
So let's take two classic examples. On one hand, you've got someone saving for a house down payment in 3 years. That's a textbook short-term goal. On the other hand, you have someone saving for retirement in 30 years, a classic long-term goal. It's pretty obvious these two people should have completely different game plans, right?
For that house fund, safety is everything. You absolutely cannot afford that scary negative 43% drop the year before you need to make the purchase. That's why this portfolio is loaded up with more stable stuff like bonds, with just a tiny slice in stocks to maybe get a little bit of growth.
Okay, now look at the retirement portfolio. It's a completely different story. With a 30-year runway, this investor can absolutely afford to take on more risk because they're chasing higher returns. They've got decades to recover from any bumps in the road. So their portfolio is packed with stocks, which, over the long haul, have historically given the best shot at serious growth.
So as we start to wrap this up, I want you to stop thinking of your time horizon as a limitation. Instead, think of it as your single most important tool for navigating the entire world of investing.
And this quote really just says it all perfectly. It's your compass. Your timeline is what points you in the right direction. It tells you how much risk to take, it sets your expectations, and, most importantly, it gives you the discipline to just stay the course when things get a little choppy.
So what are the big things to remember? First, your timeline dictates your entire investment strategy. End of story. Second, having a longer time horizon is your best friend when it comes to handling market risk. And third, you have got to match your portfolio to the specific deadline for your financial goal, always.
And once you understand that, you can create that powerful cycle for yourself. You learn, you invest, and you repeat the process to build wealth over time. Learn, invest, repeat. Investing made understandable.